In this video, we'll take a look inside the world of commodities and futures, and we're starting right now. Hey guys, Elliot here. So investing in commodities and futures isn't really something your typical investor engages in, and the inner workings of these markets remain somewhat mysterious to most. Well, I'd like to shed some light on this subject, and if you've never dealt with commodities and futures, consider this a long overdue introduction. As a well-rounded investor, this is a topic you should know about, even if you don't become an active trader. Commodities are a huge part of everyday life, and futures are a significant financial derivative. Sophisticated traders and large funds use commodities and futures to hedge against risk and make money, and as an individual investor, you can too. So let's jump right in, and as always, if you enjoyed this video and find it useful, please do consider subscribing to this channel so you don't miss any of my valuable investing and financial advice. And don't forget to smash that like button. To start off, let's first define what we're talking about. A commodity is a term from the field of macroeconomics, and it's essentially a raw economic good used in commerce that is fungible. Now, the word fungible simply means that the individual units of the raw good are interchangeable with no regard to who produced them. Some examples of fungible commodities include natural gas, copper, beef, and rice. You generally don't care who extracted the gas that powers your stove, mined the copper wiring in your walls, grew the cows for your steaks, or harvested the rice in your pantry. The producers are all interchangeable, and that's a key part of the definition. As a counterexample, a television would be a non-commodity. You will likely know exactly what brand you want and will recognize distinct differences in price, quality, performance, and style between them. As such, TVs are not easily interchangeable. Hence, the TV manufacturers will work much harder to convince you to buy their brand than the copper mine, who will expend exactly zero effort marketing their brand to consumers. There are two broad types of commodities: hard and soft. Hard commodities are mined or generated. Soft commodities are raised or grown. Furthermore, commodities are grouped into four broad categories: metals, energy, livestock, and agricultural. A few additional manufactured commodities do not fit neatly into any of the above, such as industrial chemicals, generic pharmaceuticals, vitamins, and even some high-tech ones such as computer memory. Now, how does something become a commodity? Well, that happens through the process of commoditization. This occurs as certain goods or services that were once unique lose that uniqueness because everyone knows how to make, grow, or manufacture them. An important property of a commodity good is that with a lack of differentiation factors like brand, it is the lowest price that drives sales. You can see this for yourself when you shop in a grocery store. You may be very particular about your brand of cereal or pasta sauce, but you probably won't care who sells the big bag of white rice or the gallon of milk, and you may just go for the store brand or whatever is on sale. Advertising follows this too. A TV ad that first aired in the early 1990s proclaimed beef. It's what's for dinner. The intent was just to make you buy steaks, any steaks, from anyone, and not from any particular beef producer. So in essence, that is the commodities market. Raw goods, or something close to it, being bought and sold around the world and around the clock. This has been going on for a long time, and in fact, the commodities markets were the earliest types of markets in existence and were around for thousands of years. Now, formal exchanges are of course a more recent invention, and in the United States, the first major exchange for farm commodities was the Chicago Board of Trade, or the CBOT, which opened up in 1848. It is the world's oldest futures and options exchange and continues to trade wheat, corn, and livestock. Worldwide, commodities are a huge business, with some estimates placing the market at $20 trillion per year. So how does the commodities market actually work, and where do futures, and for that matter you, the investor, fit in? Well, since commodities are produced and traded on the global markets, their prices fluctuate with supply and demand. Supply is the ability and inclination of a producer to procure a commodity and offer it for sale. Supply can decrease if costs of production go up, suppliers exit the market, capacity shrinks, weather or climate causes problems, or a political crisis arises. The supply can also increase if the above factors are favorable and the demand is high. Now, demand is the need and desire for a commodity volatility in the marketplace. Factors that increase or decrease demand are numerous and can range from consumer tastes to seasonal variations to the overall state of the economy and even pandemics, as we found out in 2020. Because supply and demand changes frequently, commodity prices are often more volatile than the prices of stocks, bonds, and other assets, and this is not good at all. You see, in the consumer market, you can manage some price volatility. If you need a dozen eggs and they are on the expensive side this week, you could wait until next week to buy them. You can also delay buying everything from furniture to electronics until they are on sale. In the commodities marketplace, it's not quite so easy. Transactions are usually made for very large quantities by buyers that often operate on razor-thin margins, so price sensitivity is a big deal. These buyers also have to plan significantly ahead. An example of this is a farmer who needs to lock in the purchase price of fertilizer to determine the selling price of his crop, the sale of which will happen months from now. Another example is an airline which pre-purchases fuel months before it actually needs it. These difficulties that I just described gave rise to futures contracts as a method to lock in a price, smoothing the ups and downs of commodities markets. It is these futures contracts that investors actually trade in, so let's talk about them next. Futures contracts, or just futures, are legal agreements to buy or sell something at a predetermined price and at a specified time in the future between two parties. When this agreement is executed, the buyer must purchase or the seller must sell the underlying asset at the set price regardless of the current market price. If this all sounds similar to options, it is, and futures are also classified as derivative financial instruments, and they rely on an underlying asset in order to work. The first modern futures contracts were negotiated for agricultural commodities and natural resources, and today commodities trading and futures are inseparable. There are additional types of futures in the market such as financial, currency, interest rate, and stock market index futures, but here we will only discuss the commodities ones. So commodity futures contracts are essentially used to lock in prices so businesses can run smoother and not be subjected to severe price fluctuations. This is exactly how the major producers and suppliers use futures to physically buy and sell the commodities at favorable prices. These contracts, however, are very versatile, and the same techniques can be used for hedging and investing purposes without the intention of ever taking possession of the physical commodity, as you really don't want 100 tons of corn in your backyard. The most common approach and the most relevant to a small investor is betting on price movements of the underlying asset. With that in mind, let's take a look at the actual investing side of commodities and futures. So first off, why even bother investing in commodities if you are a small investor? The primary reason is that commodities can be an important way to diversify your portfolio beyond traditional stocks and mutual funds. Prices of commodities tend to move in opposition to stocks, so it's a good way to protect against downturns in the market. Additionally, commodities can shield against inflation and can offset the loss in purchasing power that arises from it. For many investors, however, it's not diversification or inflation protection they like, but rather profits that can be earned in the price volatility that is commonly seen in such trading. For those that do stock day trading anyway, commodities and futures is a natural evolution from there. Okay, here are the four primary paths for investing in commodities. As an investor or trader, this is your entry point. Each path has its pros and cons, so let's cover each one. Approach number one is investing directly in the commodity. Speaking only from a theoretical perspective, this is certainly the most intuitive approach. You simply pick a commodity that you believe will rise in price, buy a fixed lot of that commodity, store it somewhere while waiting for the price to rise, and finally sell it at the new price to someone else for a profit. It's about as direct a transaction as it gets, and there are no middlemen. This is exactly what is done when investing in an easy-to-work-with commodity like silver or gold. In practice, however, an individual investor is very unlikely to do this for anything else. For example, you may want to invest in commodities such as oil, wheat, and corn, yet you are not an airline or a bread and tortilla factory. To physically take possession of enough oil or wheat and corn to fill a swimming pool is just not an option for regular folks. By the time you resolve your procurement, logistics, transport, and storage problems, you've already lost any profit you would have made and likely pissed off a lot of neighbors. So gold and silver are aside, it is clear that investing directly in commodities, while intuitively easy to understand, is impractical in every other way and is best left for the big organizations that can actually handle deliveries and can put them to good use. Your next investing approach is more complex in theory, but in practice far easier to accomplish. Approach number 2 is using commodity futures contracts. Futures contracts are an alternative to the impractical direct ownership of commodities, and this is exactly how the vast majority of commodity trading happens, both on a corporate and individual investor level. Futures can be written for any available commodity by a stockbroker using a futures brokerage account. The way these contracts work is that when the price of the commodity goes up, the buyer of the futures contract gets a corresponding increase in the value of the contract, while the seller suffers a corresponding loss. Conversely, when the price goes down, the seller of the futures contract profits at the expense of the buyer. You as an investor can buy and sell these futures just as easily as a farmer or a factory. While it will actually take delivery once the contract expires, you instead will exit the contract by selling it for, hopefully, a profit in response to price movements. In essence, this is the description of a commodities market speculator, and I will describe some more details of this approach in just a few minutes. A major side to the above approach is the large costs involved. First of all, since futures are designed for major buyers and sellers, not an individual investor, the price of even one futures contract in some cases can be out of reach. Second of all, in order to trade futures, you will need to open a margin account. This in itself can present a problem since not everyone will qualify for one. If you do qualify, both the account minimums and the margin minimums can be substantial. As with any leveraged account, margin trading can incur huge profits or huge losses, a point I will also come back to in a few minutes. Fortunately, there are some safer alternatives to get a piece of the commodities action, and that is the next approach I will cover. Approach number 3 is buying shares of exchange-traded funds, or ETFs, that specialize in commodities. ETFs that offer commodity exposure were devised precisely because futures trading is so expensive and risky, and investors do not always want to spend the time to learn how to properly trade in that market. These ETFs took several approaches to commodities. One way was to actually purchase and hold the commodity, usually gold, and each share of the ETF is then equal to a small amount of the commodity held. This is a good approach, and some of the best commodities ETFs actually specialize in precious metals. Examples of these include SPDR Gold Shares, trading symbol GLD, and iShares Silver Trust, trading symbol SLV, two of the largest gold and silver ETFs respectively. Other ETFs focus on oil and gas. Since the commodity can't be stockpiled like precious metals, in this case the ETFs invest in futures contracts instead, with the ETF money managers doing all the financial heavy lifting for you. This of course comes at a management cost, such as higher ETF expense ratios. In general, these types of ETFs can invest in specific commodities, sectors, entire industries, or be diversified. If interested, you should select them based not only on the ETF's performance, but also on your own personal familiarity with the commodities being invested in. Finally, we have approach number 4, and this is to buy shares of stock in companies that produce commodities. For example, in the energy sector, you can focus on exploration and production companies that actually find and extract crude oil and natural gas. Alternatively, you can invest in mining companies that extract precious and base metals, or in agricultural companies that grow crops or purchase them from farmers and then resell them to processed food companies and other buyers. It is important to realize, however, that with this approach, you are not investing in the commodity directly. Instead, you are investing in the company that produces the commodity, and the value of the company may rise and fall independently of the commodity itself. Okay, to finish up, let's talk about how you actually go about putting all this theory into action. Now, we'll skip approach number 1 here, as almost no small investor will realistically buy actual commodities. For approach number 3 and number 4, that is buying commodity ETFs or stocks directly in commodity companies, all you really need is a brokerage account with any mainstream online broker such as Charles Schwab, E-Trade, TD Ameritrade, and others. You can then buy and sell ETFs or stocks in your typical manner, and there's nothing special about the process. Things get more complex if you want to follow approach number 2 and actually buy and sell commodity futures and speculate on their prices. Here you may want to open up an account with a specialized commodities futures broker such as Admis, Advantage Futures, Daniels Trading, Infinity Futures, or RGO Futures. These are all Chicago based and are what the dedicated futures traders use. If you decide to go that route, there are a number of things you need to know right off the bat. Number one is that commodities futures brokers require a minimum deposit to trade futures contracts. For most brokerages, this minimum is $1,000, but that can vary widely. You must also apply for futures trading approval, and your finances and general investing experience level will be evaluated before proceeding further. Number two is that a margin account is required to trade futures with all brokers. The margin requirements will also vary widely and may be quite high. Number three is that you will need to quickly learn about pricing, market hours, and expiration. Pricing refers to the fact that unlike stocks, futures are derivatives, and their pricing is based on the value of the underlying assets. Market hours refers to the fact that many futures could be traded up to 23 hours per day. Expiration refers to the fact that unlike stocks, futures are perishable, that is, they have a finite expiration date after which they are not tradable. Finally, number four, you need to realize that compared to the trading of equities, commodity futures are highly leveraged financial instruments. This means two important things to a trader. You can experience extraordinary returns and greatly enhanced risk. In plain English, you can earn a lot and lose a lot. Okay, so let's say you clear all of these hurdles and are ready to jump in. Once your account is set up and approved, you research and purchase a futures contract for a commodity of your choice, one that you believe will have a price change before the future contract expires. You can then take a speculative position to hold the contract, which is called going long, or you can take a speculative position to later sell the contract, which is called going short. One of two things can then happen. If after you buy the futures contract, the price of the commodity rises and trades above the original contract price at expiration, then you would have a profit, which is the difference between your price and the price when the contract expires. If after you buy the futures contract, the price of the commodity drops and trades below the original contract price at expiration, then you would have a loss, which is the difference between your price and the price when the contract expires. As the contract nears expiration, the trade would be unwound and would then be cash settled either positively or negatively in the investor's brokerage account, and no physical product will change hands, as future speculators of course never need the actual commodity delivered. Now it's worth mentioning what exactly a futures contract actually contains. These contracts are all standardized. They are tailored toward actual buyers and sellers, with speculating really just being a byproduct, and will specify all the different contract parameters such as the unit of measurement, how the trade will be settled, either with physical delivery of a given quantity of goods or with a cash settlement, the quantity of goods to be delivered or covered under the contract, the currency unit in which the contract is denominated, the currency in which the futures contract is quoted, and finally the grade or quality consideration when appropriate, for example a certain octane of gasoline or certain purity of metal. As mentioned before, be careful, do not take actual delivery of the commodity, as you may be stuck with a lot of it. When trading in the futures market, you will see a number of transaction fees associated with each trade. Overall, four basic types of fees incurred during the active trading of a single futures contract. The first is the exchange or clearing fee. This is charged by the exchange directly to the trader in return for providing market access. The second is the National Futures Association fee. The National Futures Association, or the NFA, is a self-regulatory body of the derivatives industry, and they require a fee of 1 cent per futures contract traded. The third is the data fee. This is a flat fee charged to the trader by the exchange and is associated with the streaming of real-time market data. Finally, there are the brokerage commissions. Brokers charge a wide range of fees, but they are often negotiable depending on the volume of trades the trader will have. Last but not least, it needs to be mentioned that commodity futures traders don't just throw darts at the board when it comes to trades. Technical and fundamental analysis strategies allow traders to evaluate and predict the direction of futures, and both approaches are important. Traders first determine the overall market outlook and the volatility outlook. They then use this information to develop trading strategies, including trade entry and exit points. Some of the commonly used strategies include trend following, manner reversion, range trading, price patterns, bull and bear futures, and intercommodity spreads. These specific strategies are an extensive topic all upon themselves and not something we can discuss in this introductory video, but they get a mention just to give you an idea of what's involved. If you do take up commodity futures trading, you will definitely need to spend some time learning all of these and more. Okay, so this was a general overview and introduction to commodities and futures. Needless to say, this is a big topic and there's a lot more to learn, but if you understood all the concepts in this video, you can now say you at least speak the language of commodity futures traders and have a good idea what this world is all about, in case you do want to give it a try. As always, if you enjoyed this video and found it useful, please do consider subscribing to this channel and turn on notifications so you don't miss any future videos such as this one. Thanks for watching, and I'll see y'all soon.